The content of this video is for information purposes only and is based on my over 30 years of personal experience as an entrepreneur and business owner. I'm not an accountant or CPA or even a substitute for an accountant or CPA. I strongly suggest that you engage with an accountant or CPA for financial advice and counseling for your specific needs. In the previous video, we looked at pricing strategy, more of an overview. And as you could tell, there are some nuances to pricing strategy that we probably didn't dig too deep into. Now, in this video, I want to maybe drill down a little bit more, and I'm going to provide you with two spreadsheets that will be in the order below this video by which I'm presenting them. A couple of things that I want to mention before we jump into the video portion of this where I'm showing you the spreadsheet is that I'm going to make the presumption of two things. One, you have access to a CPA, bookkeeper, accountant, or someone that's a math wizard that can help you where needed and give you advice. Number two, I'm going to presume that you know how to use Excel at a very basic level, or you have access to someone that can help you with that. What I don't want you to do is get overwhelmed with what I'm about to show you. You may need to pause this video, rewind it, pause it again. But I also encourage you to understand that anything like marketing or budgets or even pricing strategy is going to require that you do research, not just one time, but over the lifespan of your business. So let's go ahead and get into this. I'm going to share my screen and we're going to look at the spreadsheet called the pricing model. And we're going to look at two different areas, fixed costs and variable costs. Obviously, the fixed costs are costs that are the same from month to month, and variable costs are costs that change from month to month. And so what we're going to do is we're going to look at this real quick. This is some examples. Please understand this is not the end all be all of the list. There could be things that you add. There could be things that you take off, but I want to buzz through this real quick. Salaries are full-time employees that get paid a set amount regardless of how many hours they work. Typically, they work 40 plus hours. And so that is where they go. And usually that is your office workers, your CEO, you, if you're the CEO, and so forth. Then we have rent. Now, the rent, lease, mortgage, that is for your office, maybe a warehouse, maybe you have a manufacturing facility. Because they're the same each month, you'll put them here. Insurance premiums could be any insurance you're paying, whether it's healthcare, dental, vision, or it's liability insurance, workers' comp, all that goes in that bucket right there. License fees and permits, these are typically they're similar to taxes, but we don't normally put them under there because license fees could be something that you're paying to a brand to partner with them, and you want to have the license to have the right to use their likeness or their logo or whatever it is. Permits can be municipalities or state, local, whatever. So keep in mind that there could be a mix in there, but that is where you'd put those. Then you have taxes. Now, this could be property taxes. It could be city, county, state, local. Keep in mind that there are usually intangible and tangible taxes for cities and counties. So you'll need to partner with an accountant or somebody to help you navigate that. Then if you have any loan payments, these are typically the same month to month. These are so let's say you got a small business loan to get launched, and that's where you would put the monthly loan payment. And then you have the interest payments on long-term debt. So this is long-term is typically more than 90 days. It's usually a year, 5 years, 10 years. And you're going to put the interest amount that you're paying each month because that's typically the same as well. Now, the next two items you will need to coordinate with your CPA or bookkeeper, and that is your amortization of intangible assets and the fixed asset depreciation expense. Those are typically given to you by your bookkeeper or CPA. And then finally, we look at utilities. This is a non-manufacturing line item here. This is, let's say, your office space. You're paying usually the same. It's usually flat billing. water, gas, electric, water, phones, and that's not just your internal office phones, but if you have cell phones as well, and internet. Now, one thing I want to mention to you is that you would put in here any benefits that are non-insurance related. So if you were paying for childcare expenses or some other benefit that is, some companies will actually reimburse you for education. They'll pay for your gym membership, that type of thing. Okay. And then your variable costs are things that change from month to month. And that is usually under the payroll side is your hourly worker, someone that doesn't necessarily work 40 hours a week. They could work part-time, 3/4 time. They could work 40, but they're paid by the hour. And also the hourly overtime, because that fluctuates. We also put under here commissions and bonuses. You can make them separate or together. Usually I keep them separate because commissions do fluctuate and bonuses are usually once or twice a year, and they are both tied to some sort of activity or event, whether it be sales or some sort of event, triggering event that allows you to get that bonus. And then we have billable labor. Now that could be a consultant or someone you're paying to specifically come in and do a specific thing. This is not the plumber or the electrician that you're coming in to fix something. This is typically someone that's coming in to do something that's related to the manufacture or sale of your product. Then, of course, we have advertising and marketing, employee travel, and then let's look at fees. Fees could be anything from credit card processing. So you take a customer's credit card number and you run it, you're going to pay a fee for that. Bank fees other than interest. This could be a late fee. This could be a bounce check fee. This could be any number of fees that the bank might charge you. And then there are fines. Fines are usually state or federally driven, sometimes local, if you have those. Now, the next two areas are going to be dependent on whether or not you're making the product or you're buying the product to resell. If you're making the product, you would use the manufacturing section of this. That would be your raw materials. What did you need to create that? You might also have a section for parts. So if you're building something and you need parts from another vendor to complete that, you would use that. It's the same as raw materials in that respect, except you might want to separate them because a raw material might be a sheet of metal. The part might be something that you stick to the sheet of metal to complete the item. Then there are production supplies. Production supplies could be gloves, they could be smocks, they could be hair nets, they could be all number of things that are related directly to the actual manufacturing process. Then we have packaging supplies. Packaging supplies is the package that you put your product in. So if you're selling, making a water bottle, the bottle itself and the label and the lid, that's all part of the packaging. And finally, for manufacturing specific, you might have water, electric, and gas because they fluctuate with the output of the manufacturing facility. Now, if you're not manufacturing something, you might have product acquisition. And this product acquisition is basically the wholesale price you're paying to buy inventory. And then finally on this list, we have logistics. This is the delivery and shipping costs. You could have warehousing costs. You might have fuel or truck maintenance if you own a fleet of trucks of some sort. All of that falls under there. All right, let's go on to tab number 3. Notice I have them in order 1, 2, 3, so you want to follow that. Now, this is where we actually get down to figuring out what it is we're going to charge for something. And because you are entering in numbers, this will tally everything here. This will tally everything here, and they will put them in the appropriate columns here. And they will add them up to give you the total estimated cost, meaning everything it costs you a month to run your business. Okay, so let's go back here to the fixed assets, fixed costs, and we're going to assume that you have 75,000 in salary, and you have 25,000 in hourly workers. So your total costs Now, obviously, you would add in other things. I'm just doing this for simplicity. Your total cost estimate is $100,000 a month. This is per month. And let's say that you're manufacturing 1,000 units of something. That means that your price per unit, what it's costing you to make it, is $100. Okay. You have to break even. To break even in your company, meaning you have no income, no expenses, it's zero. You would have to sell everything. You'd have to sell 1,000 units for $100 a month. So you'd have to sell 1,000 units a month for $100 each. So let's talk about, well, how do I know what my wholesale price is? So let's say you're manufacturing and you want to sell this to a retailer. Well, you have to do your homework. I do have some notes over here on profit margins. Profit margin is your markup. It's how much you need to make above and beyond what it costs you to make that widget, right? So your profit margin, usually the common one is 50%. So you'll notice that I have these 3 blocks in green. These are the only 3 blocks you need to change on here. Let's say that you are going to make 10,000 units. Well, now your price per unit is $10. That's how much it costs you to make it. But let's say that you want to wholesale this, and so what you're going to wholesale it at is a 50% markup. That means now your wholesale price is $15. That means you're making $5 a unit. Okay, that is your how much you're making for that. Now, let's say that you want to retail the product. You're not just manufacturing it and wholesaling it, but you're also retailing it on your own website. And the question is, well, how much do I want to mark up this item? Well, you could go with a 50% markup. You could go with 100% markup. Let's say that it's a candle and you're retailing it you're wholesaling it for $15. It's just an example. You want to retail it because it's a premium candle. You want to retail it, so you're going to give it 100% markup. That means your retail price now is $30. You can play with this. Maybe you are making 100,000 units. Your price per unit is $1. You want to make a 50% profit margin, so now it's $1.50. And now you want to make a 300% markup, so you're going to make $6. So basically what that's saying is you're making a $5 profit. Okay, play with this. This is a really fun spreadsheet to play with. Now I want to bring up a second spreadsheet, and I'm going to open up the screen a little bit. Now this is a sales pricing calculator. I'm not going to get too deep into this because I don't want to overwhelm you, but I'm going to provide this to you in the event that you want to dig deeper into the different pricing models that are available to you. Those pricing models are competition-based, meaning you're going to have to know what the competition is charging. You're going to look at the cost plus price. Now, that's kind of what I just showed you. There's the freemium pricing, meaning that you're offering, this is usually in the service area where you offer something for free, but after a trial period, they upgrade to a fee, or maybe you offer a freemium that gives them maybe 2 features, but if they want all the features, they have to pay a fee. Then there's the hourly pricing, which kind of explains itself: skimming pricing, penetration pricing, premium pricing, meaning you're having exclusive pricing, project-based pricing, and value-based pricing. So I'm just going to jump through these real quick. Again, I'm not going to spend a lot of time on it, but you can click on each one of these buttons right here. We'll go to the competition-based pricing. You will fill in any of the light green fields here. So you need to know what your competitor's price is, your price. What is your price? What are you going to sell it for? Then there's the product variable cost, and there is the projected number of units you're going to sell. And then these two here, all these other lines will populate with it. Again, I'm not going to go too deep into these. If you want a little more detail on it, you can do some research on your own or talk to a CPA or accountant to help you with this. Cost plus pricing. You need to know what your unit variable cost is. Go back to the spreadsheet I just showed you. Then you want to know the projected number of units sold. So let's say you're expecting to sell 1,000 units a month. That'll tell you then you need to know what your fixed dollar amount increase is and what your markup is. This is how much you want to increase your amount in a dollar amount. So let's say you want to increase it by $5. Or you want to increase it by 50%. You get to choose those numbers. This gives you a what if analysis. Then if you want to look at the freemium, again, number of free users, then the freemium to premium upgrade rate. So you're going to assume that you're going to have a 25% upgrade, meaning that they are free, but they 25% of them upgrade. And then you want to enter in what you believe the cost of the premium product to be, and then it projects your revenue. Hourly pricing, again, this is if you're doing a service and you're charging by the hour, self-explanatory. Skimming pricing strategy is where companies charge the highest possible amount that they can get for a new product. And then they lower it over time as the product becomes less popular. And this is used a lot of times for technology. You'll see it in some fad things. So, you may not use this a lot. Now, penetration is the opposite or the contrast of skimming pricing. This is where you enter a market with an extremely low price, drawing the attention to yourself, and then you gradually increase the price. Premium pricing is where you have luxury goods. Think Louis Vuitton. And I do realize there's a spelling error there. I'll fix it before I save this. Project-based pricing, this is where you price by the project. And you will need to you'll need to figure out what the average cost of a project is, and then project the number of annual projects that you're going to produce. Now, your average cost per project, that's something you're going to have to spend some time figuring out, and you may need to do some research. And then finally, value-based is where you price your product or service based on what the customer is willing to pay, even if they charge more for a product elsewhere. You can decide to set your price based on what the customer is interested in. This is all based off of data and research. You have to do your research. Okay. That is an overview of some pricing tools. Again, this is a bonus video. And as always, check with a CPA, bookkeeper, accountant, or some math genius that might be in your sphere of influence to help you with that. That's all for this video. We'll see you in the next section.